So, you want to know how to enter your market consistently to increase your chances of highly successful trades, right? You want to know where to enter your market so the price does not immediately move against you, stopping you out of your trades, or even worse, losing control and losing more money than you had originally planned or hoped for on the trade, right? You want to hop in on that beautiful trend and ride that sucker for massive profits. If this sounds like you, then you are in for a treat. I'm excited to share with you my own personal strategy rooted in solid market fundamentals that work for me like clockwork. A strategy developed from 13 years trading in the markets, with 5 of those years as a full-time futures day trader. Within all that experience was a ton of time and money wasted, testing everything under the sun until I finally found what I was looking for. All of which I will be sharing with you right now. I will be breaking down my entire process that could revolutionize the way that you approach your market, pulling back the curtain and revealing it all. So sit back, relax, and get ready to take some notes. And if you aren't a note taker, towards the end of the training, I will explain how you can grab a copy of the replay and an action-taking PDF that goes with the training that I created, laying out all the steps so that you can implement what you learned here today. Sound good? All right, let's dig in.
All right, so I just wanted to take a second to make it clear, because I don't do it in this part of the video, that what I'm gonna do is I'm gonna explain the entire strategy, and then I'm gonna break everything down in the charts so that you have a chance to see things and have the visual side of things and not just the auditory of me explaining it, which, looking back on it, it's a little hard to do. And so if you don't realize that the chart training is coming, then it could be a little disappointing. But don't worry, I'm gonna explain everything pretty thoroughly. I'm gonna go through each step, and then I'm going to break everything down really well in the charts. So just wanted to go ahead and throw that in here. Let's get back to the video.
Most of the time, if you are struggling with getting good entries on your trades, the problem is usually twofold. You are inconsistent with how and when you decide to enter your trades, creating a mix of decent and crappy entries, or you struggle to identify where you are at in the trend, and so you look for as much confirmation as possible that the trend will continue, causing you to enter late, and then the market usually moves quickly against you. Oftentimes, it is a combination of both. Unfortunately, the things you may try to do to eliminate your risk in the trades becomes the exact thing that increases your potential to lose money. It is almost impossible to enter your trades consistently if you are not approaching your market and setups consistently, and this requires a few things. It's what I call the 3 keys to a successful and profitable entry strategy. Again, this is my experience and what has worked for me in the markets over many years. My hope is that you will gain massive value from my experience and then apply it to your own situation. This training is broken up into 3 parts. First, I'm going to tell you what the 3 keys are. Then I'm going to tell you the 3 techniques that are needed to use each of those keys. And last but not least, I'm going to show you exactly how to use the techniques so that you can use those keys to unlock each door and therefore change your trading for the better, forever. Sound good? All right, here they are. Key number 1, that you have correctly read the trend. This ensures that the market is actually going somewhere and you are jumping on board with the strongest side of the market, increasing your chances of a successful trade. Key number 2, that you understand where you are currently within the trend. Entering too early or too late within the trend will drastically hurt your chances of a successful trade. Ideally, you want to enter a relatively new but established trend. Key number 3, that you have let the market sweep you into the trade with momentum in the direction of the trend, ideally after a pullback. When you let your market show you it's ready to move before you jump in, you immediately increase the odds of having a great entry. Now, when you combine all 3 of these, you end up with a very consistent and powerful trade entry strategy, which is exactly what I'm going to teach you today. These 3 skills combined into one powerful strategy to help you start nailing your entries. The description of these 3 keys greatly simplifies the journey that lies ahead. You might even say that they are an oversimplification, and I'm okay with that. Simplicity leads to clarity, which helps unlock each step that you need to reach your destination more quickly than you would otherwise. My trading game was developed over many years of unnecessary rabbit trails and detours that slowed down my own progress to profitability. So hopefully you can learn from some of the wisdom that came from my pain. Now that you understand how the 3 keys can help you accomplish your goal of creating a successful entry strategy, it is time to understand how to use each key. The 3 techniques used to unlock the potential of each key are the technique to use to unlock key number 1, correctly reading the trend using multiple time frame analysis. Using this strategy, identifying the trend becomes super quick and simple. Now, there are two rules at work here. First rule is that an established trend is much more likely to continue than to stop and reverse. So if you like picking tops and trading against the trend, then you are really working against the easier path. Second is that the higher time frame, the stronger the trend is, and that you should always be looking at what the greater trend is and trade with that trend. Technique used to unlock key number 2, understanding where you are currently within the trend. Without going too deep into cycles or trading jargon, I hope it is obvious to you by now that the market does not go straight up or down. Inside of trends, there's buying and selling pressure that causes all kinds of funky stuff to happen. To keep things simple, you need to understand 3 specific scenarios: pullbacks, reversals, and consolidation patterns. It is important to do your best to understand what your market is trying to do, and you can do that based on what has happened in the past. Technique used to unlock key number 3, to let market movement, aka momentum, sweep you into the trade. Rather than just randomly picking a spot that looks or feels good, I let the market lead the way and show me what it wants to do and where it wants to go. So I use my favorite tool of all time to read and gauge momentum, and then wait for a simple and straightforward trigger to tell me when to get in. I will share what that tool is and how to use it shortly. So to quickly summarize what I just said, you identify the highest time frame trend that will have the strongest influence on what happens to the chart you are trading, and make sure that the trend is going in the direction that you want to trade. Then you switch to your trading time frame and identify exactly what is happening, and you wait for a good trade setup to appear. Then you wait for your trigger and you let the market drag you into the trade and watch your P&L go green. Simple enough, right? Here's a pro tip. Too many people complicate trading when one of your number one goals should be to keep things as simple as possible. A common reason for those struggling with consistency is because you may have made your trading plan too complex and difficult to follow. Simplifying everything in your trading process will automatically cure all kinds of trading ailments associated with consistency and discipline. All right, so let's look at how to implement each of these techniques. Multiple time frame analysis. I use multiple time frame analysis, aka MTA, because the biggest moves in your market will be in the direction of the largest trend, with the least resistance possible. A powerful quote is that a rising tide lifts all boats. Trading is hard enough, and so we want to trade with the rising tide, not against it. Now, there are 2 rules when using MTA. Rule number 1, the highest relevant time frame must be trending in the direction that you wish to take your trade in. Rule number 2, your trading time frame must be trending in the direction that you want to trade in. If it is not currently trending, then you must wait. We will identify each trend by using trend lines. Ideally, you have one time frame higher and one time frame lower than your typical trade decision based time frame. So for example, if I'm trading from the hourly time frame, then I'm watching the daily chart for my trend direction. And when the market is trending well, I can look for tactical entries on the 5-minute chart. My favorite trading tool is the line tool, and I primarily use that to draw trend lines and support and resistance so that I can easily see the trend and the trend development. This is the fastest and simplest way to identify the current trend. If the current trend is not well defined, then I prefer to wait until the trend becomes clear. These are my simple rules for trading success using trend lines. In an uptrend, I connect my line tool to the higher lows, and in a downtrend, I connect it to the lower highs. The trend line does not get adjusted until the market makes a new high or low, depending on the trend direction. People try to complicate identifying trends, and once again, I think it is best to have a simple and repeatable process. All right, got it? All right, let's keep things simple and moving along. Trading time frame analysis. Our job as traders is to read our market to the best of our ability so that we can make good trading decisions. One of the most important aspects of that job is to map out the risk profile of the trade and determine if it makes sense for us to take. Like a trade filter. If you're just entering at random, then your results will be random, and that makes it impossible to test, track, and then improve your results. You want to limit your risk and then maximize your profit. In that order, you are a risk manager first, and then a profit taker second. Once the higher time frame has been confirmed, then you determine what state that your trading time frame is in. Has the market been running or trending for a while and is probably ready for a break? Is the market already pulling back, setting up for its next move higher? Is the market consolidating in some obvious pattern that you can track? And then it will be obvious if the pattern results in success or failure. You can use the same trendline process with your trading time frame to determine the current trend. Once you've confirmed that the higher time frame is trending and that your trading time frame is in alignment with that trend, now it is time to really drill into your trading time frame and assess what is currently happening. Ideally, you want to enter during a pullback. The reason for this is twofold. First is that it helps you reduce your risk on the trade. For example, if you are targeting an uptrend and the trend is strong, entering on a pullback helps you get a better or lower entry and gives you new market structure that you can use to measure your risk, aka potential loss, and price levels to target, where to take profit at. That being said, you have to take what you're given while you wait for your trade entry to develop. So once again, I like to simplify my perspective. I view the market in only 3 shades: uptrend, downtrend, or consolidation. And if you cannot decide which is which, more than likely it is consolidating. If the market is in a downtrend, then you want to wait for it to become an uptrend and then wait for a pullback. If the market is in an uptrend, then you wait for a pullback. If the market is consolidating, then you wait to see if the market breaks out in the direction of the trend, and then you wait for the market to pull back and get ready to enter. Once you have a pullback you are targeting, then it's time to wait for momentum to switch from down to up, bears to bulls, sellers to buyers, for an uptrend. When you wait for price to start moving in your desired trade direction before you enter, you are doing 3 important things at once. You are improving the odds of the trade immediately going in your favor. You have new market structure that you can measure your initial risk based on. And most importantly, this creates a process that is simple and repeatable. To accomplish this, we will wait for the market to break a counter trend line, letting us know that market momentum has moved back in the direction of the trend. You draw a counter trend line on the current pullback, connecting those lower highs, and then wait for price to break above the trend line. Once it breaks above the trend line, it does not matter much whether you wait for the bar to close or even set an entry price trigger above the trend line. Most importantly is that you pick what works for you and you stay consistent with it. The other real option here is just to guess when you think the market will stop falling and then reverse higher, which is the definition of trying to catch a falling knife. The first option makes for a much more enjoyable and profitable trading experience. It is why I choose to have an entry trigger over buying at random during a pullback. I promise you, I have tried every strategy under the sun, and I am telling you that the momentum trigger is the way to go. Here's another bonus tip. When the market pullback is not clear or it's messy on your trading time frame, you can drop several time frames so that you can draw your trend lines more clearly. But be careful. There can be a strong temptation to make trading decisions from what happens on that lower time frame chart. So just make sure you're sticking to your trade plan on your trading time frame. The fast movements of the lower time frames can be fun to watch, but ultimately they are a distraction from the stronger and more important movements that are happening on the higher time frames. All right, let's quickly put all this together so that you can view how powerful this entry strategy truly is. Another pro tip. Once you enter the trade, you should expect for the trade to perform and move in your favor. If it does not, then you want to cut that loss quickly at your initial stop placement. You should be impatient with trades that do not do what you want it to do, aka move against you, and you should be very patient with the trades that are moving in your favor, though maybe not as quick as you would like them to. Now this makes good sense and seems obvious, but if you've been trading for a while, then you understand just how hard this is to do. Most traders struggle to become profitable because in most scenarios, they do the opposite of what they should do. They baby those losing trades, hoping that the market will turn around, and then make very poor emotionally based decisions in the process, like moving their stop lower or the ultimate account killer, adding to your losers.
So on the daily time frame, right? This is our long-term time frame that we're determining the long-term trend off of. We have seen the market consolidate through here, move higher, back down into this previous consolidation here, and then break out higher. Okay, it is broken through these highs here and confirm the trend line. This trend line here was already drawn from the weekly time frame, so we already know that that things are in alignment with the highest time frame possible, because the highest time frame has the most potential force and power and sustainability. So now that we know that the daily time frame is back in alignment with the much bigger trend, but it has confirmed that it's now in an uptrend, right? We are drawing this uptrend line based on that market structure. So we've got that there, right? And then we can see that broken through the previous highs, and then the market begins its pullback, okay? And so it's not giving us much here. The market has broken the highs, the previous most recent highs here, okay? And then the market begins to pull back. So now we're going down to our hourly time frame, which is our trading time frame, Okay. And we can see the established uptrend here. Market's pulled back to it, launched higher, and now we're getting a meaningful pullback on our trading time frame, right? So based on this, we were able to draw one counter trend line based on these lower highs here, but then the market accelerated to the downside, and we got even lower. We have even lower highs that we can now draw a new trend line from. Okay, and so oftentimes I will keep this here just so that I can see it, and then I'll draw the new accelerated trend line just so that I can see exactly where both points of resistance could be, right? Because I would imagine that market participants are using both. All right, and so what we're waiting for is, now that momentum has shifted to the downside at this point, if we look here, right, because this is our trading time frame, we can see that the market momentum was higher. It broke the uptrend line, and now it has started a new downtrend within the daily uptrend, right? So this is which is the definition of a pullback. A pullback is a downtrend within an uptrend. Now that market has broken this trend line, signifying that the immediate buying pressure has now subsided, and the sellers, whether that's larger market participants, whether that's just profit takers, whatever, it doesn't really matter, has broken the trend line, and now momentum is moving to the downside. Okay, that is the most important thing to wrap your mind around, is that you should be constantly drawing these trend lines to quickly identify where market momentum has shifted. At this point, market momentum has shifted from the upside to the downside. Okay, and so that constitutes a trend line, a new counter trend line being drawn. And then once new lows were made, and then lower highs and new lows again, now we can redraw this trend line, and we can see that not only is the market momentum shifted to the downside, but now it is even more strongly moving to the downside. Okay, and so what we're waiting for, instead of just randomly buying down here in this area, we're waiting for that momentum to shift back to the upside and for buyers to take control. And once we have that, then we have the assurance that we have the long-term uptrend is higher, right? And so the more than likely that trend will continue. And so people are looking for places to buy. People are buying at all levels. They're buying randomly. But what I have found, and I believe that other market participants that move the markets, they are waiting for some sort of trigger. And so what I think what we're doing here is that we are just aligning ourselves with other market participants that are waiting for essentially for momentum to shift to the upside. And so that's what we're doing, is we're jumping on their coattails. So because that's all this signifies, right? This is very, very simple and very, very basic. There is no indicators here. There's nothing but lines drawn on a chart, right? But if you draw these lines and you start following this and you do the practice that I'll share with you at the end of the video, you will see that the market momentum shift happens all the time. And it's really all you need. This shows you everything that they're showing in any kind of momentum indicator or anything else, right? That the market shifts from upward momentum to broken trend line, the momentum shifts to the downside, and then the market breaks the trend line, the counter trend line back to the upside, and momentum shifts back to the upside. Now at this point, as you can see, any pullback in price is relatively short-lived, right? Because the dominant buying pressure from the higher time frame is where the larger money is flowing into. And so what you see is, and that's why this makes sense and is so powerful, is because we're just looking for the market goes up, profit taking happens, some market participants sell, and then it's getting bought up by larger players on the higher time frame. And so all we're doing is it's stair stepping. And so we're using that stair stepping, and we're avoiding the down steps, and we are taking advantage of the up steps, right? Kind of like in a ladder, right? So that's what we see here. So market momentum is moving to the upside with the trend, right? We get a nice solid move here, and then the move to the downside, it lasts for a little while, right? But compared to this move here, this move is pretty small and shallow, and that's what you'll see. That's the whole point of the multiple time frame analysis, and the reason behind that is because that higher time frame trend is going to dominate unless big enough, volume comes in and completely changes things. And then that's a different story, right? But we'll see that because we're not just randomly buying. We're waiting for the trend, for that momentum to shift back to the upside. So we just continue to watch this. We don't do anything until the market moves back to the upside, breaks the trend line, and gives us the trigger entry that we're looking for, right? If the market were to continue to sell off, and let's say this was the high, guess what? It's going to continue to sell off here and go lower and lower without us. So we don't care about that, right? It doesn't matter. That doesn't affect us. It only affects us once it shows us what it is trying to move back in the direction of the trend. And once it breaks down here and moves down below this trend line, at that point we know that momentum and the trend has shifted on the higher time frame. And guess what? We get to pass on the trade. So all that's super powerful. Okay, so let's just run through and see how this worked out. So we've got a move to the upside here. We've got a short move to the downside here. Momentum has broken. Market momentum has shifted. It's moved higher. It's broken this counter trend line. And so this is a point that we would enter. Okay. And what we can see is we take very, very little heat on any of this, right? If you were to enter immediately after it breaks the trend line, you get a little bit of a pullback here, but then market quickly continues to the upside. Okay. And then market moves up. Okay. At this point, we can see and we can tell, we've got our daily trend line here drawn, right? So we know that market momentum and direction continues to be solidly to the upside. And then we start to see some pullbacks. So here's a decent one here. All right. We got another one here. And what I like to do, and I mentioned like drawing the counter trend lines, I like to draw them where they connect at the lower highs, right? Because a lot of times that first move lower typically is gonna fail. There's usually at least 2 tests to the downside. Okay, so as you can see here, let's see, this one happened here right after momentum moved back to the upside. So let's use this guy as an example here after it's run, right? And you can even see here, like there's one, and then there's 2, right? So this would be an acceptable entry here. But if you look here, right? Let's draw another trend line here. Okay, this vertical move to the downside, right, where a little bit of market structure was broken here. Sellers are trying to get control of the market, especially if a trend line has been broken. So let's take a look at that real quick too. All right, let's say here. Okay, that the trend line's been broken, right? Oftentimes we will get another move and another test to the downside. So I prefer to wait for the second move lower. You get a solid lower high, you draw your trend line, and then that is where you go. Now, if we can move it, now if there's another one and it moves lower and then it moves lower again, we can draw that trend line lower and tighter. But for this circumstance, I look for at least the high to connect to at least one lower high and then wait for the breakout there. But still, as you see, right, every single one of these pullbacks versus the move higher, right, pullback, move higher, they are lower for the most part. This one's the same, right? It matches it, but the move higher is it moves significantly higher than the counter trend pullback that happens, right? So this is why trading with the trend is also so powerful as compared to trying to pick tops, right, or bottoms and try to figure out exactly where the market's going to turn, right? Because if you do that, you're eating it all the way up here, right? Every time the market breaks the trend line, the short-term uptrend line, and you're trying to make money, you're trying to catch that move to the downside, it just doesn't make sense, right? We're better off waiting for the long-term trend to be broken, for the trend to switch to the downside, and then do the opposite if you're interested in trading short. Okay, so you continue to see it, right? We continue to see, here's this vertical move lower, right? And so this is one that I would typically skip. We got this guy here. We got a lower high, so we know that there. See, it's had, and that's another thing too, is that we point out that we can see that the market tried to move higher. So there was a little bit of an attempt of momentum shift, right? But then the sellers overtook that, drew the market lower, and then now once we break up through that, it has more meaning and significance. All right, and then so we see again another small pullback and a larger move higher. Okay, now here, this guy here, very, very sharp move, right? but within the context of the higher time frame trend on the daily chart, right? No real damage has been done here, right? And so for something like this, I would be careful with it, but something like this, you could even move to a lower time frame so that you can see the market structure itself, right? Because we had, let's see, a move from 3,800 all the way down to 3,200. And so that's, let's see, quick math, 380, that's about 15% of a move within a short time frame, right? And especially if you're familiar with crypto markets, that's just kind of, those quick moves happen and they do end up being typically good buying opportunities, but it also could be the beginning of a down move. But when you have very, very sharp movements, as you see here, you see a sharp movement to the other direction, right? So if you're able to get in down here, because we're going to drop down here to this movement here, okay, we can see that this worked out well. All right, so we have that more accurately drawn. That if you would have bought randomly through here, right, you really could have gotten eaten up, because if you're trading smart, you're putting a stop in, but you have no idea where it's going to finish at, right? And so now essentially we have one solid move down, an attempt to move higher, and then it really kind of waterfall and cascades lower here, right? And so on that higher time frame, right, this was essentially one move. You couldn't even see that. This was the one little move that was kind of like a cross on the one on that one candlestick, but that doesn't count, right? Based on what we're looking for kind of two legs down. So that's what we see here. We see the first leg and then the second leg. And then, like I said, if we get those pieces that are that additional momentum to the downside after that second leg, then we can draw a new trend line lower. And so at this point, you now have an entry. We are entering in with momentum, solid momentum to the upside. And you can see as soon as this trend line is broken, the market is happy as can be to go ahead and rejoin that trend back to the upside. And again, you're taking very little heat. If you're entering in right after the trend line was broken, market's pulled back close to your entry, but it's nowhere near where you would have your stop lower, and the market's just free to move back to the upside and move higher. And then at this point, okay, we got our entry. We took advantage of that downside momentum, and then we are back in the game. And so we see here, so this was another good entry here. We see that two-step lower here. We connect a high to the lower high, and then market continues to move up. And then we can see here too that the trend begins to change. That there's a bit of there's less momentum, right? So now we're seeing these moves up higher. Even here, right? A significant pullback, but it did not result, even though it retraced the move, it did not result in a significant move higher, right? And so we're seeing the momentum change, right? These swings from the shallow pullbacks and the long runs, we're starting to see them start to match the moves to the upside, right? And so that's actually a bit of a warning and a bit of a heads up that things are that the buyers are losing their buying pressure and that the sellers are starting to take control on the higher time frame, right? So if we switch over, that's what we see too here. We're seeing these get shorter, comes up, and then market begins to roll over here. And we can actually see that we can technically draw. We can draw these trend lines too within the higher time frame charts. I actually consider this is what's called I call it trend line accelerations. This little bonus, okay? But that's technically it's a new uptrend, a new faster uptrend within the uptrend itself, right? So you can kind of see 3 here, and 3 seems to be a pretty good mark. Once we get to the third mark, the market's not very sustainable at that point. Anything could happen because we have this pullback here, this little swing here. So we've got higher high, higher low, and then another higher high. We can draw this here. And so at this point, okay, we switch back down to our early chart. It looks like this is the actual high. So this would only get drawn to this point here. And at this point, once this is broken, right, the momentum has shifted to the downside on the daily chart. Okay, so regardless of whether or not market structure is intact, sellers are in control on the higher time frame, and opportunity is going to essentially vanish from our trading time frame, right? And so at that point, now we start back over, go back to our multiple time frame analysis, and we're now watching our daily chart. We're waiting for the trend to become reestablished, right? It has now shifted over, and if you look at it, the trend has now shifted to the downside, right? If we're looking at this being the higher time frame, this momentum and the trend is now moving lower, and not only one, but two trend lines have been broken to the downside. And so now we don't want to do anything on the hourly time frame to the upside until we wait for that higher time frame to become reestablished to the upside. And so now what we have a counter trend line drawn on the daily chart, right? So this connects the highs, go back down to our hourly. And so essentially what we're waiting for is we're waiting for confirmation. Okay, so if we're trading on the hourly time frame and we're watching to wait to see what happens on the daily time frame, we're waiting for the momentum and for the direction to switch back to the upside. And so what's that going to require? Well, just like the pullbacks and the counter trend lines that work so well on the lower time frame charts, the same thing works for the higher time frame charts, right? Like, as I mentioned, right, when we come over here, we already said that this was our weekly time frame, right? This is our weekly, the weekly time frame trend line. So we know that the weekly trend is still up. If we're looking at the day trend line from a high level perspective, we can see that the market is still strong to the upside. But the immediate thing is that the market is moving lower, and that is what affects our trading time frame. And so that's the most important thing going on in our world and in the decisions that we're going to make. So, but what we can be rest assured of is that a counter trend line break back to the upside in the daily time frame probably has a very, very good chance of reestablishing that uptrend and for the market to continue to the upside. And so, okay, if we're trading on the hourly chart, what we would want to see, the daily counter trend line be broken, move higher, and then we would wait for the pullback. And then once that pullback happened, we would draw us a new counter trend line, and then would be entering the market that with the momentum back to the upside would be the game plan there. So obviously that's not as ideal as the scenario where, you know, the market has broken all the recent highs and it's just moving higher and it's cruising and it doesn't seem like it has an issue. But this is how that you can use what's happening on the higher time frame within that context to now make good trading decisions based on your time frame as well.
And that, my friend, wraps up this training on how to enter your trades like a pro. Now that you have learned the framework for how to put together a great entry strategy, you should be able to approach your market with confidence when looking to take your next trade. Not only that, but when you create a solid strategy rooted in solid market fundamentals, you can trust the process and therefore implement it consistently, which is key to any successful trading strategy. So congratulations on investing in yourself and being open to new ideas and processes. It really is truly the only way to learn and grow. And thank you for allowing me to share what I have learned over my trading career with you. But the true change and transformation comes from intentional practice. So now it's time to get your hands dirty, get to work implementing what you have learned. If you enter your name and email below, not only will I send you this presentation so you have the replay forever or as long as you need it, but I will also send you the PDF cheat sheet for the action steps that goes along with this training to create your own consistent and repeatable trade entry process. And by the way, if you do this, I will also send you a bonus advanced trading on how to target trades that generate massive returns. Trust me, it's awesome. Listen, I hate emails, so if you do sign up, just know that I will never send you anything unless I think it's awesome and valuable. After you enter your name and email, look out for an email from Chris@acceleratedtrading.com. And if you are watching this on YouTube, just click the link in the video description box below that will take you to the sign up form to get you the same bonuses and a crap ton more that I have planned. I really hope that you have enjoyed this presentation, and if you've gotten any major breakthroughs or aha moments, I would love to hear about them in the comment box below. If you have any questions or want to chat, please reach out to me at Chris@acceleratedtrading.com. As in most things in life, if you don't give up, you win. Thanks for watching.